Thanks, Brian, for joining me today to have a chat about the economic and the economic impact of the coronavirus and also the investment markets. How's life in lockdown in Adelaide for you?
Lockdown's pretty good here in Adelaide, especially where I live. I've got the wineries and I've got the wine cellar and I got the walking track. So I'm the fittest I've ever been, but the drunkest.
Very good. Okay, well, before we start, of course, we've got to do our disclaimer that sort of anything in this presentation is just general information. So if people have got questions on their specific circumstances, we'd obviously encourage them to seek advice from us or a qualified advisor. So moving on to, you issued a note this week where you talked about some potential scenarios that might happen, from the best case scenario where we might have contain the virus and have a V-shaped recovery, to, I guess, a worst case scenario where we might go into a deeper recession. Yep. I guess your thoughts are sit somewhere in between. So I'll let you have share some slides and have a chat about your thoughts on where we're heading.
Thanks, Paul. Yeah, I'll start off with a bit of the history of where we are, and I think that's probably pretty important. So if I go through what's happened is with China, we started off with a supply shock. China went into lockdown first, and she's the world's manufacturer. And because she couldn't manufacture because she's locked down, we found that the rest of the world was lacking goods to sell. And so as the market demand was still in place, the prices or the deliveries slowed down the economy. That was the first part that hit us. The next phase we're going to go through is the demand shock. And that's because there's no demand. As the economy slowed down faster, and you think how quickly our unemployment has jumped in Australia, but in the US, it's already hit 15%. So this is the fastest and deepest since World War II for them. So when we look at other parts of Europe and also here in Australia and Japan, unemployment's a little bit gradualer, but we are seeing certain sectors of the market, especially the youth unemployment, is starting to rise very quickly. And we expect youth unemployment to get close to around that 20% level again, which it was after the GFC. I think the demand shock is coming through because we just don't have the money to go and buy things because we're now fearful. The next phase that we'll go through is the financial shock. And we've seen the government actually act very quickly on this globally. No government is trying to stop a recession, and I'll bring that up front because they can't. This is driven by a shutdown, not because of bankers did something wrong or a government did something wrong. It's a virus and it's caused the world to shut down. So it's uncontrolled in that sense. But the financial consequence is massive. And with the massive people losing their jobs so quickly, and the fact that, especially in Australia, we have the highest debt to GDP on a personal base, especially in mortgages, we're in risk of a great shock in this country. So the government stepped out very, very quickly and threw money into the system at a rate that we haven't seen before. Now that's all about to stave off the loss of confidence, stave off the uncertainty, and also to reduce interest rates, because when the world gets uncertain, Paul, what we do see is the cost of money rises, and that's exactly what we saw in credit markets around the world. So we're actually seeing those credit spreads come back a little, but they're still high, and that's causing financial ripples in the market where companies' borrowing costs have gone up at a time where their sales and revenue has fallen. So what we're seeing is central banks around the world are trying to cushion that component. So if I look at where we are today in the cycle, we are globally in contraction. For your clients, Paul, that have seen this chart for the last 20 years, we've been right through the whole cycle, but there's always been countries in a different part of the cycle. This time we're all synchronized. We all came together. And China was starting to move out of recession, but has gone back into it. But the rest of the world's caught up. So as I said, we are in stage 1, which is the recession coming through. Stage 2 of this will be how do we get out of it and how do we unwind it? And I think it's pretty important. And what we're seeing with governments now, and from the very early stage, and this chart, it actually just shows you what the initial response was that governments spent, in Australia, we spent 1% of GDP. We're going to hit 15% of GDP in expenditure in this country. We're around 10 at the moment. So the government's coming out with packages all the time. We've had package 1, 2, 3. We're going to probably see package 4 come through. Same with in the US and Europe, etc. So, but you can see we've done 2 things. We've cut interest rates and we've printed money at the same time, or pushed money into the system. Currently, this money is through bond purchasing. So the governments are buying back their own bonds and keeping the interest rates low globally. In Australia, we've anchored our 3-year bond rates at 0.25, for the 3-year curve and the 1 and 2 year curve. So money is very cheap for the banks, but the banks are asked to do a lot of heavy lifting, and hence why their share price is so low. The banks are the ones that are going to give even the job keepers room to move on their mortgages, allowing business to borrow to pay wages, so they get JobKeeper because they've got a month before the money comes in. So we're seeing very unusual structures come through, but it's good because the banks were saved by us as taxpayers in the GFC. Now the banks are saving us back through this virus. So it's a good balance that we're seeing come through. But the mantra is whatever it takes. And I think this is very important, that and this is why I think our recovery pool will be in the middle and not at the extreme end, that we could end up with QE 5, 6, 7, 8. If there's a second wave of infections, we'll see central banks around the world come out with more printing. And this will have consequences, and I'll touch on that in a minute. But it shows that we are very aware of what's going on. Governments are very aware. No one wants to see a depression, so we'd rather have short, sharp recessions. That is what they're trying to get us out of, I guess.
Yeah. Brian, were you surprised because the Fed has actually gone further than the RBA? Like the RBA is buying government bonds, but the Fed's buying actually right down the curve, corporate bonds, not junk bonds. But were you surprised that the Fed went so far?
No, I think their structure is a little bit different to ours. Their banking system is pretty solid, but not as solid as ours. But if you think about their interest rate curves being pretty flat for a while and margins have been tight, so we saw a lot of money get invested into junk debt and triple B debt, so to chase interest rates. There's a lot of money in mutual funds and ETFs in those sectors. And if they were to allow them to collapse, you'd see a massive wipeout. So it's interesting that the Fed knows this, and he's turned around and said he will actually buy into the ETF market to support the junk debt. Now, he hasn't done it yet, but the market's calmed down because they know there's now a put in place that the Fed will jump in and protect the investments on that side. So this is unusual. I don't know how the Fed unwinds it, but and I don't think what we'll do is see unwinding of all this stimulus for a long time. The GFC took them nearly 8 years to unwind it. This could take longer. So it will give confidence, and this is what this is all about. The cycle of this demand shock going through to the financial crisis. We're all trying to stave off a financial crisis to make this a recession and not a depression. So my scenario, Paul, is in really every country is going to be different. We are in Australia, we are in a very good box seat. We are very much a baseline case economy. We've got no new cases peaking since April, early May. So we're already in that first component. We've locked in, I think we had 8 new cases for Australia-wide. So we've really got the curve flat. We see some of the major lockdowns starting to move. In Adelaide, we're allowing elective surgery. I think that's going to be nationally soon. So we're seeing the business starting to reopen in some sectors. I think we've seen credit markets still stay elevated. That's probably the only thing that's concerning at the moment, that because we're not supporting the bond market or the corporate debt market, we are seeing those spreads elevated by 100 basis points at the moment. But I expect we'll see that come down once the economy opens up. So we're very much in baseline where we could see growth come back into Australia instead of being 3 quarters negative, we'll probably see 2 negative quarters, and by September we'll probably start to see the third quarter looking a little bit more positive. In the US and Europe, 2 different cases. So in the US, Donald Trump was very slow in getting out. He didn't believe it. He thought it was a cold, and he virtually told everybody to just keep doing what they wanted. He's very much worried about big business and supporting him there, and so the American package from the government was very small. He's now sped it up to the degree where every week the Congress is approving a new measure to keep the economy going. So I expect that their lockdown is going to be longer, probably getting out towards that late June before they start moving people around. So they will probably not recover until the late half of the early half of 2020 if they open up by June. If they open up in the late part of June, say July, August, then we won't see any recovery in the US until the late half of 2020. But the good news is we will see all these markets bottom before the recovery comes through. So the share market volatility we're experiencing at the moment is a sign of working out where are we in the cycle. Are we going to be early openers or late openers? And I think in Australia, our market's a bit high, going by the rally we've had, but I'm pretty confident that we've tested the bottom in our share market. We may retrace almost back to the same low we had in March, but I don't think we'll go lower than that at this stage. How that affects us with the other scenarios with Europe and America being a bit longer. Japan is obviously going to be a lot longer. They've got a second wave that's gone through them now. So that's going to mean some of our export markets are going to suffer. And so our scenario will be a slow growth recovery, not a fast growth recovery. So I think in Australia, even though we'll be back on track, we'll have more of a U-shaped recovery. We'll have a flat period in the economy, and by 2021, we'll start to see things turning around as normal. And if we get a vaccine at the same, by the next 12 months, that will even give us a faster recovery. More confidence will come back in. So in the scheme of things, when we look back in history, we can see that the average recession lasts for about 12 months. So we're 3 months into it. So I think your clients can take comfort in some sense that we're a third through it. Share markets that will look ahead of this by 6 months. So we'll get a pretty good sign on our recovery in the markets as we start to see the price of nickel rise. We start to see oil prices stable, those sort of things. There'll give confidence that risk is coming back on. If I go through my 7 assumptions, and I think there's 2 parts to this. One is that this gives you a pretty good idea of what we think the world's going to look like going into this, and the next slide will show how I think the world's going to come out, Paul. So if I look at it, the first 3 boxes where we've got the economies, we've all gone into recession, we agree with that. Most markets are going to have at least 2 quarters of negative contraction in the market, and then we'll see a bounce back coming back in the following 3 to 4 months after that. It might be a little bit shorter for Australia. We might see some of our industries bounce back in 2 months. I think if it goes past that 3 months, we don't see things bouncing back within that period. It's going to be a long time. And hence governments are very aware of this, and I expect that they will do everything in their power, hence QE4, to get the economies moving. Central banks, I think they're employing MMT, which is modern money theory, which is printing money, basically. With America, they're doing helicopter drops already. In Australia, we're not doing that as yet to the same degree, but Every pensioner got $750. That was gifted to them. The government's got to issue bonds at this stage, but we expect to see more of that stimulus. We're seeing the JobKeeper is some people earning more money being unemployed than when they were working. So this is all the gifting of money that's coming through, which is part of modern money theory that's come through. The stimulus, it's very, I think it's quite significant, but it won't prevent the contractions that we're going to see in the markets, and especially in the economies, but it's to feed us coming out the other side. So that's the whole idea. So I think the wild card in all this is probably the commodity demand, and we've seen this in oil prices. I think that's quite disruptive. So that could cause a problem on the other side, especially with Saudi and Russia and some of the poor emerging markets. They've got their revenue stream suddenly died, and they've got their currencies higher than the US dollar. So they've got their cost of capital, everything rising against them, and that could anchor the emerging markets in a bit of a slow crawl out of this whole cycle, which will affect some of our sales, obviously, coming forward as we export to those markets.
Have you ever seen anything more bizarre than that negative price on the May futures contract for oil? That was quite a bizarre situation, wasn't it?
Yeah, it shows how much the economy has dropped off in growth, how rapid it was. Production takes a while to unwind, and they've run out of ships. They've run out of storage. I think we've got nearly 80% of all storage taken up now. In parts of Asia, they're building super tankers and can't build them fast enough to store more oil. So it's a crazy situation. And yeah, for a month there, they were paying you to take the oil off their hands. So yeah, I need a bigger tank. But I think this is just showing the disruption. We've had negative yields, Paul. Who would have thought that? Now we've got negative oil prices. This is showing that the world globalization has been keeping everything in balance. Now we're not globalized. It's showing that we've got too much supply in the system. And that will take a while to use up. And so I don't see a floor in oil prices any time in the short term. But in the longer term, I think where we're sitting around that $12 a barrel is probably about right. And that we'll start to see the futures from July onwards start to push up again. So I still believe by this time next year, we'll see oil around $60 a barrel. And I'll touch on why in a minute. The last one is that one of the problems with globalization has been this transfer of this virus, COVID-19. And I think what we are going to see is deglobalization. This has made people very aware of their supply chains, how they can be disrupted, not only from manufacturing, but for drugs, for protective equipment, even for our food supply. So all of a sudden, we're going to see governments rechange the supply chain. And this is actually going to hurt the Chinese economy because they're not going to be the dominant force anymore. I think we'll see the digital economy really start to pick up because of this as well. Things like you and I are doing today. I can't hop on a plane and be there with you, so we're doing this interview. So I think we are going to see out of this some deglobalization in the way we work, but also the way we now conduct business. We'll have more storage and we'll hold reserves of toilet paper, for argument's sake. So if I look at what I think is going to be the structural shifts going forward, and I think this is very important for clients to understand, is that the world's changed for good. And I think the fact that we've been able to expand for so long was quite surprising with globalization. But since Donald Trump got into power, we've seen that talk of deglobalization grown greater voice. We've seen more populist politics. I think that's going to be a big issue going forward. We're going to see people vote to control borders now. We're seeing racism rise. We're seeing the acceleration in telco space, what we're doing. We're going to see some massive changes come through. I think the main thing I think we'll see though, Paul, is that we'll see the rise in basic incomes. I think this is going to show that we need a base income for everybody. Because when these environments happen, one of the things that have come out that people in the arts or people who are on working visas don't get any support. So they're going to need some support if this happens again, which it will, to keep them going through and coming out the other end of the economy. The central banks, I think we're going to see them buy more corporate credit, Paul. I think we're seeing it in America. We'll see it more in Europe. Japan's been doing it for ages. And I think if we look at Japan as a canary in the coal mine, this is how the world's going to look. We're going to have aging populations, huge amount of government debt. You're going to have a huge drain on revenue coming through. So you're not going to recover that money you're printing and spent in bonds. So you're going to keep interest rates low. And I think that Japan's got minus interest rates at the moment. We're down to 0.12 on a 90-day bill, when inflation's still running at above 1. So when I look at it, our money is already negative in real terms. So I think we are going to see the interest rate environment stay low for a good decade. We're going to see a surge in investment from governments. It's the easiest way to get the economy moving. We'll bring forward our infrastructure. China's doing it. Japan's doing it. It's great for Australia. I think the fact that China is going to have a massive infrastructure spend is going to be good for our commodity prices. And we've seen that in the price of iron ore. It's held up pretty well through all this. So I think the key things we're going to see is further deglobalization, acceleration of digital. We're going to see the telco space become bigger and bigger, and especially for Skyping and for broadband technology. Even Netflix had a record in sign-ups because people are bored at home, so they're watching more Netflix. I think the corporate buybacks, I think what this is showing, a lot of businesses were too busy buying back their shares. They've left no money in the bank, so I think we'll see buybacks being quite questionable going forward. So some bad practices will be ironed out until probably the next 10 years, and then we'll forget it and go back to how we were. So overall, I think for Australia, I'm very positive on us. I think we're very close to retesting our lows or get close to them. I wouldn't be chasing this rally. I'd let the rally work through. It'll take 2 or 3 months, Paul, but then get ready to move in. And my key areas I think we should be looking at are utilities, infrastructure, building companies, your paper packaging groups, and food suppliers. I think they're all pretty safe investments to hold. Banks, they're going to be under pressure for a while. I think they will take probably another 6 months or so until we see those September figures come out and we see if the economy is moving back on track. But they're going to be carrying the load for a while. So banks' margins are going to be under pressure.
Okay, well, thanks, Brian, for sharing your insights. It's very interesting. It'll be interesting for our clients. Of course, we would normally be welcoming you up on the Sunshine Coast in May for our quarterly updates, but we can't do that this time around. But we are going to run a live stream, so clients will be able to listen in to your full presentation. So really appreciate your time today, and you take care.
Thanks, Paul, and you keep working on that suntan and your paddleboarding, and I'll keep working on my cellar.
Okay, very good. Thank you.
Take care.